If you're buying your first home, a mortgage credit certificate or MCC from VHDA could save you thousands of dollars by reducing the amount of federal income tax you owe. An MCC is not the same as an income tax deduction. Instead, an MCC is a dollar-for-dollar tax credit that gets subtracted from the amount of federal income tax you owe. So, how much are we talking about? The credit is equal to 20% of the annual mortgage interest you pay. So if you pay $10,000 in mortgage interest in a year, an MCC would allow you to take 20% or $2,000 off the amount of federal income tax you owe. And the remaining $8,000 can still be taken as a deduction. Let's look at an example. Stan and Pam are buying their first home. Their gross income is $50,000. The first year that they own their home, they'll pay $10,000 in mortgage interest. Without an MCC, they would simply deduct that $10,000, leaving $40,000 in taxable income. Assuming a 15% tax bracket, they'd owe $6,000 in federal taxes. Now, let's see what the difference would be with an MCC from VHDA. Their gross income is still $50,000, and they're still paying $10,000 in mortgage interest. However, instead of taking the entire $10,000 as a deduction, they only deduct 80% of it, or $8,000. That puts their taxable income at $42,000 and their federal income tax at $6,300. And now, they apply the MCC credit. This takes the remaining 20% of their mortgage interest that they didn't deduct, $2,000 in this case, and subtracts it from the tax they owe. This lowers the total they owe to $4,300. So with an MCC, Stan and Pam save $1,700. And the savings are not limited to just this first year. The MCC is effective for the life of their mortgage, as long as Stan and Pam live in their home. So, could you benefit from an MCC from VHDA? Well, there are some requirements. You must be a first-time home buyer or not owned a home as your primary residence within the past 3 years. This requirement may be waived if you're purchasing a home in a federal targeted area. You can see a list of these areas on VHDA's website. You must use the home as your principal residence. The sales price of the home you're buying must be below a designated maximum, and your household income must also be at or below a designated maximum. You can find these limitations listed on VHDA's website. And of course, an MCC won't benefit everyone. For example, it can't reduce your federal income tax if you don't owe any taxes in the first place. You should also be aware that if you obtain and use an MCC and then sell your home within the first 9 years, you may be subject to a federal recapture tax. VHDA will determine which homebuyers qualify for an MCC under the Internal Revenue Code, but we do not and cannot give tax advice. So, talk to your tax advisor to determine if an MCC will save you money and how valuable an MCC could be to you over the life of your loan. For many first-time homebuyers, an MCC could be an excellent way to boost the tax benefits of owning a home, putting more cash in your pocket for as long as you live in your home.
Learn more at vhda.patricknorman.net.